Did somebody have it? Not yet? All right, good. Many people are getting 187 to 68. Awesome. Okay, so 187 to 68. So that is the total investment amount the company has to have saved by December 31, 35, by the time that Joe retires, so that the company can pay Joe $30,477 10 times during Joe's retirement. Okay. Now then, second step is to discount this amount back to today's date. Today's date is December 31, year 11. All right, so present value at time t, where n equals how many periods are we discounting this back? 24. Good. Right here. From December 31, 35, the retirement date, back to December 31, year 11, today's date. It's 24. Interest rate is 10. Payment is 0. Always, the second present value calculation doesn't have a payment. It's just a present, so discounting a lump sum back to the present value. And then future value is, that is what we are trying to discount, 187 to 68. Then present value at time t will be awesome, 19,013. 013. So 19,013. Then, so let me go back. Share. Present value at retirement is 187 to 68. Present value at time t is 1913. When we calculated in the previous problem, the present value at time t was 20,914, assuming Joe worked in year 11. In here, assuming Joe did not work in year 11. The difference between these two numbers, the present value at time t equals the total, so company's total obligation for Joe, right? And so that's basically the PBO as of December 31, year 11, assuming Joe worked in year 11, assuming Joe did not work in year 11. So the difference between these two numbers is basically how much the PBO balance increased because of Joe's service during year 11, which is his service cost for year 11. So if we take the difference, 2914 minus 1913, that is 1901, which is the service cost that we calculated in the first problem. The service cost over here, that was 1901. So our PBO balance increases with the service cost, basically. Among other things, actually. That's one main part, but this problem here just illustrates that PBO increases with the service cost. That makes sense, right? So we introduced two present value calculations, whether it is service cost or PBO. The first is to calculate the present value at time, at the time the employee retires, so present value at retirement date with the number of payment periods, and then discount rate, and what else? The payment. And then we discount that present value at retirement back to the present value at time t, and that will give us, if it is for 1 year, that will give us the service cost. And then if it is for multiple years, then that will give us the projected benefit obligation. So far, any questions? If you are here, you can freely show yourself. Okay, no questions. All right, then let's move on to the next part that goes into the pension expense, interest cost. So with any liability, PBO is like any other liability. So with the passage of time, your liability increases with time, basically. So we apply the beginning PBO balance by a rate that's called the settlement rate, and then that will give us the interest cost, which contributes to the pension expense. And what is the settlement rate? Settlement rate is an interest rate assumed to hypothetically settle all its defined benefit obligations. So if the company we assume that in a situation where a company has to pay back all their obligations on one day, then this rate will make the company pay back all their liability to their employees. So we use this hypothetical settlement rate to calculate the interest cost. Return on plan asset is basically, if you have an investment account, then with the rate of return, your investment grows. Same thing here. So company saves money or puts the check into the plan asset, and over time they want this investment fund to grow so that they can. So if they have positive return on the plan asset, then their portion of payment can go down. But if this plan asset doesn't result in good return, then the company has to put more money into the plan asset. So the return on plan asset, same thing, beginning plan asset balance, we apply the expected return or actual return rate. And in our class example, the expected and actual return will be given as the same rate. And then that way we can calculate the return on plan asset. So far, we've looked at these three items: pension expense equals service cost plus, or service cost plus interest cost, and plus or minus actual return on plan assets. PBO, beginning projected benefit obligation, plus service cost plus interest cost, minus benefits paid. So this benefits paid is the check paid out of the plan asset to its employees. So if once the employee retires and then the plan asset pays benefit or a retirement check to its employee, the company's liability decreases. Therefore, benefits paid makes the PBO balance go down. And then lastly, plan asset, we start with the beginning plan asset, and then if we have a positive return that increases our asset balance, if we have negative return that reduces our plan asset balance. And then contribution is how much the company contributes toward the plan asset account. And then benefits paid, if you pay out of the plan asset, then your plan asset balance goes down. Therefore, minus benefits paid. We will add one more thing to these three things. One last thing is the amortization of prior service cost. So what is prior service cost? So sometimes companies don't have a plan, so that the defined benefit plan when they start the business. Maybe they can adopt a defined benefit plan after a couple of years. Then when you start, for example, if you start the plan in year 5 of your business, then what do you do with the past 4 years of the service that employees have contributed to the company? So if you don't ignore those 4 years, then your employees will not be happy because that reduces how much they can get paid toward their retirement. Therefore, to make your employees happy, most likely your employer will decide to give the prior decide to give compensation for the employees for the service provided by these employees before they had any defined benefit plan. So this cost to the company is called the prior service cost. Okay? But then as you can imagine, when a company has multiple employees and for a multiple number of years service, if they suddenly adopt the defined benefit plan and so if you have to expense all these prior service costs on one date, that will be a huge expense in 1 year. Therefore, what we are allowed to do is, instead of putting this one-time increase in PBO into the income statement, we use other comprehensive income. Other comprehensive income is an account that goes into the equity section on the balance sheet. Therefore, what the capital market is more concerned is the earnings per share, which is based on our net income number. Therefore, if we don't make this one-time expense show up suddenly in the income statement, but hide it or put it into the other comprehensive income account in the balance sheet, that will not have a dramatic effect on our earnings per share. Therefore, in the first year when we adopt the defined benefit plan, we put it into the other comprehensive income in the equity section, and then over time, we amortize this OCI for the prior service cost, and then this makes its way to the income statement through through the pension expense. So let me see. Therefore, now in the pension expense, if company adopted the defined benefit plan in the middle of their business, then it not only includes all these things, but also includes the amortized prior service cost. So basically, you divide the total prior service cost into the remaining service years, and then add little by little over time into your pension expense. Take it out of OCI account and then put it into the income statement through the pension expense. That's amortized prior service cost. And another thing that affects this, that this prior service cost affects is the PBO. So earlier, we only had this much. Now with the new prior service cost, in the first year that prior service cost is calculated, we include the total prior service cost into the PDO balance, and that will be it, because that prior service cost, the lump sum or the big amount can only calculate it once when we first adopt it. All right, and then OCI, because we'll have the remaining prior service costs that that hasn't made their way to the pension expense yet. Therefore, OCI will have unamortized prior service cost balance. In this part, let me see, this part, here, I included the way we calculate the total employee years. However, since in our class we only look at a case where a company has just one employee, you can skip this part, but just know that when we amortize the prior service cost, we will just take the total prior service cost and divide it by the average service life. So the average remaining service life of this employee, okay? So that will be it. So if you want to review what I just said, you can go back to here. So basically, to reduce the huge shock on the income statement, we do not include this total prior service cost as an expense in the income statement, but we put it into the other comprehensive income section, and then over time we amortize this OCI, and then put it into the pension expense, and that way the prior service cost makes its way on the income statement. Okay, let's see. Let me open up our practice problem number 1. Okay, how are we doing? Good, good, good. All right. All right, great, fabulous. All right, practice problem number 1. The Blazer Company began a defined benefit pension plan for its one employee, Albert, on 1/1/16. Albert is expected to retire in 3 years on December 31/18. So he has 3 more years to go before his retirement. Albert's salary at the inception of the plan is $30,000 and is expected to grow at the rate of 5% per year until his retirement, 3 years of growth. So from here, we can calculate his final year salary, right? Currently, his salary is $30,000. Next year, it will grow by 5%, so 30,000 multiplied by 1.05. The following year, it will grow additional 5%, so we'll do that 3 times. Therefore, his final salary will be 30,000 multiplied by 1.05 to the power of 3. We'll come back to this. Albert is getting credit for his 15 years of prior service to Blazer Company. So right here, it explains that the company is adopting this defined benefit plan as of 1/1/16. At this time, since Albert has already worked for the company for 15 years, the company decided to give him his prior service cost based on his past 15 years of service, even if during that time the company did not have any pension plan. They are adopting it new, but they decide to give him or reward him for his service for the past 15 years on top of additional 3 years that he will work on. All right, so from there we can calculate the prior service cost. The pension formula used by the company is like this: 2% multiplied by number of years of service and then highest salary. The settlement rate is 8%, so when we discount the future cash flows, we will use this settlement rate 8%. And also when we calculate interest expense or interest cost, we will use this settlement rate of 8%. Expected rate of return on plan asset is 10%. So this 10% is only used when we calculate the expected return on plan asset. That's the only time. So right here, hint under number 1, I provided that be sure to use the expected return on plan assets when calculating the growth in plan assets. All other present value calculations should be made using the settlement rate. Okay, so so when we calculate interest cost and any present value calculation, we will use the rate of 8%, but then when we calculate the return on plan asset, how much the investment fund or plan asset grows, we will use 10%. Okay. It is expected that Albert will receive 10 retirement checks starting 1 year after his retirement. So 1 year after his retirement date, that's an ordinary annuity. The payment is made at the end of each year, and then Albert is getting 10 retirement checks. So we assume Albert will live 10 additional years after his retirement. All expectations are realized, and there is no change in actuarial assumptions during the period 1/1/16 through December 31/18. So this is to simplify the problem. We do not go into any other things other than, I don't think, problem 1. Blazer Company will accumulate the funds for Albert's retirement by paying equal amounts on December 31, year 16, 17, and 18. So since they are adopting this defined benefit plan, they haven't saved any money so far. Therefore, they are making equal payments toward the plan asset these 3 times. And then hopefully they will have saved enough for Albert's retirement by December 31/18. And our job is to find out how much the company has to save each year on December 31, year 16, 17, and 18 to have enough for Albert's retirement. Okay? Amount paid will accumulate to a value equal to the projected benefit obligation on December 31/18. That is what I just explained. All right, so number 1, calculate the funding payments required so that the balance in the pension fund at December 31/18 will be equal to the PBO at December 31, year 18. So give it some thought. So the question that we are trying to answer is this. Let me see. Once I put it, I don't know how to. Okay. Calculate the funding payments required so that the balance in the pension fund on December 31/18. So let me draw that. December 31/18. Funding payment. So so is today's date 1/1/16? The company will make payment toward this pension fund. 1 time, 2 time, and 3 times, right? Right now, they are just beginning this pension plan. They have nothing in their plan asset. Therefore, they are trying to figure out how much they have to save for the remaining years, just 3 years for Albert, and so that they have enough to be saved for Albert's retirement checks for 10 years, right? So the balance in pension fund will be equal to the PBO balance at this time. What is this PBO balance as of December 31/18? That will be, so by this time, how many years has Albert will Albert have, how many years Albert have worked for the company? Total, not just these 3 years, but yes, is it 18? So before 1/1/16, he has worked for the company 15 years? Was it 15 years? Yeah, Albert is getting credit for his 15 years of service, and then he is working 3 additional years. Therefore, the PBO at this time will be based on 18 years of service. Then, let me see. Based on his 18 years of service, can we calculate his pension check? 2%, 18 years. His final salary, right now his salary is 30,000. Increases 5% per year, but to the power of 3 for 3 years. Therefore, his pension check will be 12,502. So after Albert retires, what he's getting from the company is 12,502 per year based on 18 years of service. Then can we calculate the company's obligation as of December 31/18 based on all the information that we have so far? Oh, um, it's not, it's not just the, since it's a 10-year period and we are adopting or including or calculating the present value all the time, we will discount it to the present value at time of retirement. Okay, so let me increase. So we will, so that is basically PBO as of December or at December 31, 18, which is basically the present value at time of retirement is when interest rate is, was it 8%? Number of periods. How many checks does the company pay to Albert? 10. He is expected to live 10 years in his retirement. And then the payment amount is $12,502. We don't have any future value. Then present value equals 83,889. Okay, good. Now then, that is by this time, the company's obligation to Albert, based on his 18 years of service, is $83,889. Then company's obligation, to satisfy the obligation, company has to save and grow the money to $83,889. Then the question is, calculate the funding payments required so that the balance in the pension fund at December 31, 18 will be equal to the PBO at December 31, 18. So how much does the company have to save this X for the next 3 years at the end of each year to have this 83,889 at the end of the third year, at the end of the third year term? Our question here is, so we have the future value. This is the future value when we are standing right here, right? 83,889 is the future value. These three are equal payment amount. Number of periods is 3. And then interest rate, go back to the hint. It says, be sure to use the expected return on plan asset when calculating the growth in plan assets. So we will save X amount at the end of each year for the next 3 years, and then we want it to grow, and the expected growth rate is 10%. So the growth amount will, so the rate that we assume is 10%. So lastly, we will, what is X? Now that is number of periods is 3. Interest rate, we grow this investment or this saving to grow 10% annually. And then payment, future value is 83,889. And then the payment is basically the X, what we are trying to get. All right, 25, 344. Thank you, Song. So what is this 25,344? The company, if the company saves 25,344 for the next 3 years, and if the company assumes 10% rate of return on its investment, then they're saving toward this plan asset or pension plan will grow to 83,889 by the end of year 18, which will be enough to cover Albert's retirement check of 12,502 for 10 times during Albert's retirement years. Make sense? Any questions? Move on. Number 2, determine the year 16 pension expense. Pension expense. If we go back to, let me see, if we go back to the lecture note. Pension expense has these things. So let me copy and share again. Not this one. Practice problem. Okay. Pension expense includes service cost, interest cost, plus minus actual return on plan asset, plus amortized prior service cost. Okay, so let's start with the prior service cost. Okay, so to calculate pension expense, we need to go through some steps. Okay. Prior service cost. Starting with prior service cost. So at the inception of the plan, liabilities based on Albert's 15 years of service will be generated. So that is the prior service cost. Based on 15 years of service. In the retirement check, we will include his 15 years of service. So let's start with the pension check based on the pension formula. 2% multiplied by number of years of service, 15, multiplied by the final salary. I didn't give the number earlier, but the final salary, if we do 30,000 multiplied by 1.05, to the power of 3, that is 34,729. Therefore, the pension check based on Albert's 15 years of service is 10,419. Present value at time of retirement will be based on the interest rate. We'll use the settlement rate other than the case where we calculate the rate of return on plan asset. So interest rate that we use will be 8%. Number of periods. In the first present value calculation, the number of periods is the number of retirement checks to be paid to Albert. So basically, how many years will this employee leave after his retirement date? So that's 10. Payment, based on his 15 years of service, we just calculated the retirement check or pension check will be 10,419. Future value 0. You don't have to put 0, therefore. Now, the present value at retirement date is did you have 69,912? Good. Awesome, Tiffany. All right. So 69,912 is the amount that the company has to have to pay Albert based on his 15 years of service. Now that we discount it back to present value at time t, I is still 8%. Number of periods, when are we standing right now? At the inception of the plan. So today's date is still 1/1/16. This is the date we are starting the defined benefit plan. So retirement date is 3 years from today, right? We are discounting this amount back to today's date, therefore n equals 3, yes. And then, what else do I need? Payment is 0, but the future value is 69,912. Then the present value at time t is 55,948. 55,498, that is the prior service cost. And at the same time, that is the PBO balance as of 1/1/16. Because they didn't, so this is the first day of this plan, therefore this prior service cost today on today's date is the PBO balance, the total obligation balance. Questions so far? All right, then Second thing, let's do service cost for year 16. Service cost, same thing, start with the pension check, 2%. Service cost for year 16. So in the pension check, how many years of service will go in there? Just one, right? For year 16. Multiplied by the final salary, 34,729, and therefore the pension check is 695. So based on Albert's service for year 16, his pension check is 695. And then we discount it to the present value at retirement. I equals 8%. Number of periods. The first present value calculation, the number of periods is basically how many years the employee will live after his retirement. 10. How many retirement check he will get. So 10. And then payment is 695. Present value at retirement is 4,664. The second present value calculation is present value at time t. We discount this lump sum to the time t, which is, by the way, service cost for year 16 will be as of, so service cost assuming Albert worked year 16. Otherwise, he wouldn't have earned his service cost for year 16. So as of December 31, year 16. Right? Keep that in mind. And then interest rate we are discounting is at 8%. Number of periods at retirement, that is December 31, 18. We are discounting it back to December 31, year 16. So what is the number of periods in that case? Yes, 2. So from December 31, year 18, back 1 year, December 31, 17, back second year, December 31, 16. So number of periods discounting is n equal 2. And then the future value is 4,664. And as a result, the present value of this lump sum back to time t equals 3,999. Any questions? Let's figure out interest cost. Interest cost is beginning PBO balance. So PBO beginning balance multiplied by the settlement rate. Beginning PBO balance is, we calculated at the beginning of the year, 1 year 16, 55,498. So 55,498 multiplied by the settlement rate of 8%. So interest cost is 4,440. Expected return on plan assets. Beginning plan asset balance multiplied by the expected rate of return. So let me, beginning plan asset multiplied by the expected rate of return. Expected rate of return is given at 10%, but we don't have any beginning plan asset balance because yes, we calculated the annual saving amount from number 1, and that was in the whiteboard, that was 25,344, but the first saving occurs on December 31, 16. Therefore, as of 1/1/16, we didn't have any balance in the plan asset account. Therefore, 0 multiplied by 10%, that's 0. So we calculated the service cost, interest cost, and return on plan asset. Last thing that goes into the pension expense is the amortized prior service cost. So for the 15 years of service, we calculated the prior service cost to be $55,498. Therefore, so amortized prior service cost, take the total prior service cost, $55,498, divided by the average remaining service years. In this case, we don't have to really calculate the average because we only have 1 employee and he has remaining years of service for 3 years. Right? Therefore, annually we will amortize this prior service cost by $18,499 per year. So at first, when we calculate this prior service cost for $55,498, we put it into the other comprehensive income that decreases, and then that gets out of OCI and put into the pension expense per year, $18,499. So instead of recognizing $55,498 as part of the pension expense in 1 year, by amortizing prior service costs, we are allocating this prior service cost over 3-year period so that the shock is a little less. Now we are ready to calculate the pension expense. Then pension expense is service cost $3,999 plus interest cost $4,440, and then return is 0, and then amortized prior service cost $18,499. Total year 16 pension expense will be $26,938. So this is year 16 pension expense. You know, next week is spring break. Yeah. Any plans? Move around the house? Questions on pension expense? All right. Let's calculate the PBO balance. Number 3, determine December 31, year 16 PBO balance. Let me copy from the lecture note. PBO balance. PBO balance, beginning PBO plus service cost plus interest cost minus benefits paid plus total prior service cost if new. Okay. What was the beginning PBO? We didn't have any PBO. We will include the prior service cost because this is the first year that we adopted the pension plan. So we will include the total prior service cost since it's new. Okay, so but then since it's new, we didn't have any beginning PBO balance. Add service cost that we calculated above, service cost of 3,999, interest cost 4,440, and then benefits paid. So benefits paid will be the amount the retirement check paid out of the plan asset. We didn't have any, so that's 0. So this is plus, minus, and then total prior service cost if new, total prior service cost 55,498. Therefore, ending PBO balance is 63,933. We can calculate the PBO balance as of December 31, year 16, using the present values, right? Shall we do that? So another way will be the pension check based on how many years of service? So as of 1/1/16, Albert worked for 15 years. He worked 1 additional year, so based on his 16 years of service, pension check will be 2% multiplied by 16, multiplied by the final salary 34,729, and that is 11,113. Present value at retirement, interest rate is 8%. Number of periods, the first present value in any calculation, how many years the retirement check will be paid? How many times? 10. Good. 10 payment, 11,113. Then present value at retirement is 74,569. Discounted back to the time t, present value at time t, which is as of December 31, year 16. So interest rate is still 8%. Number of periods from December 31, 18 back to December 31, 16. How many years back? Thank you, Lauren. 2. Future value is 74,569. Therefore, present value at time t is 63,931, which is off by 2, but that's okay. Rounding errors. Okay. Any questions? So we will finish this up, this problem on Thursday, and then on Blackboard, there is an extra problem, I think I posted. In chapter 17 folder, there is extra practice problem. So we will finish this and then do extra problem. Yes, either way is fine. Yes. But I think it would be better if you know both ways. That helps you understand the worksheet that we'll be looking at on Thursday. Okay. All right. We cannot smell each other, but still we can see each other and hear each other. As long as the internet connection works well, I think it's the best option that we have. Oh, it's 2:15. I will leave the classroom, but I will not close this meeting room. So what I was told is to make you guys socialize on a virtual space if possible, if you want, so that you can communicate your difficulties and at least talk to somebody if you live on your own. Okay. All right. If there is any questions, I will be leaving. Okay. And I'll see you on Thursday.
Bye, Professor. Thank you.
Sure. Thank you.
Bye, Professor.
Bye.
Bye, Professor. Thank you.